Private credit software risk, a looming shock. There is a skeleton in the private credit closet tied to loans made to software firms. Recent reporting shows mounting exposure that could trigger a sharp reckoning, even while public markets rally. As of late 2024, the largest publicly traded business development companies remained active lenders to software firms, with roughly $27.7 billion deployed across about 2,075 loans. Average loan size was about $13.3 million, with interest rates typically in the 9 to 14% range. That exposure has likely grown since. A handful of big private credit players account for the majority of these loans, concentrating risk. Some firms led by dollar volume made large, high-value deals, others pursued many smaller, higher-velocity loans. That concentration, top lenders making up more than 85% of the market to software companies, magnifies systemic vulnerability if the sector weakens. Public market weakness is already visible. Software indices are down significantly while broader indices are flat. Bond prices for several enterprise software issuers have fallen. In private markets, signs are subtler but worrying. Refinancing deals have been halted, and software-focused private credit funds have faced heavy redemptions. Some funds paid out large percentages of assets to meet withdrawals, and several BDCs faced elevated redemption pressure amid falling yields and concerns about losses after high-profile defaults. One structural problem is deal vintage. Many buyouts and loans were made at peak valuations earlier this decade. Those deals now face AI-driven disruption and tougher exits. Analysis suggests roughly a quarter to a third of private credit portfolios face heightened threats from rapid AI adoption. Forecasts point to rising default rates in private credit, possibly increasing by a couple of percentage points this year, and worsening prospects for profitable exits without deep discounts. Software businesses are uniquely exposed because their assets are largely intangible: code, licenses, and human capital. When a borrower fails, recoveries can be poor compared with physical collateral. AI-related substitution risks, drops in sales growth, shorter product lifespans, and rapid obsolescence for back-office and admin-focused tools, raise the chance of low recovery values for lenders. Practical implications: loan portfolios heavily exposed to software face concentrated credit risk, especially where refinancing windows have closed or valuations have fallen. Rising interest rates and narrower lender appetite increase pressure. Investors and creditors should watch redemption flows, default trends, and how funds are marking illiquid holdings. Policymakers and market participants should note that trouble in private credit can emerge without the same transparency as public markets. In short, private credit's sizable exposure to vulnerable software companies looks like a potential shock waiting to happen. Markets may not fully reflect that risk yet. Keep an eye on default forecasts, fund redemptions, and asset valuations in the software lending book.